Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US Credit and Global Market Engagement at Informa Global Markets. I'm here with my colleague and co-host, Bruce Clark.
Morning, Shanks.
Head of Rates Market Coverage. Morning, buddy. Today, we'll be discussing debt capital instruments that blend the characteristics of traditional bonds and equity. They're called hybrid bonds and or preferred securities that are used by companies to raise debt that count as equity, so they could use them to raise money without harming their credit ratings that are determined by debt to equity ratios. So that explanation shows it is a very complicated part of the debt capital markets, but that this particular asset class is seeing wider adoption, and a lot of companies are using it to maintain leverage ratios and diversify their investor base, to maintain regulatory capital. So we'll be also talking about broader credit markets and how they have coped with this on again, off again narrative of de-escalation in the Iran conflict. So why are these types of complicated instruments being used to raise debt? What is drawing investors and borrowers to them? Are credit markets ignoring longer term risks from the Iran conflict? We'll be asking answers to these critical questions, difficult questions, to Dan Botoff. Hi, Dan, the global head of DCM Syndicate at RBC Capital Markets. He has over 20 years of experience advising clients in all areas of fixed income. Prior to joining RBC in 2014, Dan spent 5 years at UBS, where he was the head of US fixed income syndicate desk. And before that, with Citi for 14 years, involved in both syndicate and debt capital markets coverage. Welcome, Dan. Thank you very much for joining us.
Thank you both for having me.
Hey,
Good
Dan.
morning.
Yeah.
Thank you, sir. So let me kick off the questions, Dan. So I'm going to start with a very simple thing. What are these hybrid bonds and who uses them? Why are they important?
Well, you gave a pretty good overview on what they are. But I think you hit the nail on the head. These are securities that have a mix of both debt components and equity components. They sit within kind of the mezzanine portion of the capital structure. They do offer a number of different benefits for the corporate issuer. They also offer, given how they're structured and where they sit in the capital structure, a higher yield or a higher spread for investors. And the use case is numerous depending on how a corporate or a financial institution is structured. Some of them are for regulatory reasons. Others are for leverage reasons, as you discussed. Right. But many of them are built to offer a non-dilutive equity content solution for these borrowers.
Right. And do you, like, who uses them? Do you see a lot of companies using them, or?
So in many cases, again, depending on what structure we specifically target, if you think about the capital structure of banks, particularly in the United States, you're going to see the use of preferred stock as a vehicle for the regulatory capital needs. As you transition into corporate and non-bank financials, you're going to see a greater use of junior subordinated debt securities, or as we term hybrid securities in this case, for a number of reasons. Historically, preferred stock was used more so, but over recent years, as rating agency qualifications have changed depending on some of the structure, the use of junior subordinated debt that offers a high equity content as well as tax deductibility for many of these corporates has become a major benefit and a catalyst for a transition out of necessarily preferred stock, which is not tax deductible if you're a taxpayer, into a debt instrument. So we do see industrial uses, industrial issuers using them. We see the utility space, which is a very large and has historically been a user of this, as well as many other non-bank financials that can still get the benefit of either the regulatory treatment,
Right.
the equity treatment, or in many cases, both.
Wow, it's a very it touches so many different asset classes, which is really fascinating. So what kind of volumes of these kind of instruments are we seeing, say, compared to this? I saw a lot of those deals this year, and we have seen a lot last year as well. But what kind of volumes have you seen so far?
So year to date in the U.S., we're just below 30 billion. The run
Right.
rate last year was in the mid 80s.
Wow.
And if you think about not only the U.S., but the issuance throughout Europe, throughout Australia, Canada, our major markets that we look at, you've
Right.
seen a consistent growth over the last 3 or 4 years of anywhere 30 to 40% increase in volumes that have come in these securities for a couple reasons.
Right.
And I think the dynamic of not only the why an issuer might look to do this,
Right.
but importantly, a who on the other side would invest in these securities.
Right.
You can't have one without the other in this market.
Right.
And the continued growth and demand for fixed income securities from investors has helped to mitigate the funding needs
Right.
and absorb the flow of this increase in capital. So in some markets, we've seen anywhere from a 25 to 40% year-over-year growth in these types of securities. In other markets, it's been much, much higher year-over-year. And if you started that clock, depending on where we want to start, but if you started it maybe at around COVID in 2020 to where we're sitting today, we've seen a little bit of fits and starts depending where rates have moved. But over the last 3 years, you've seen a steady increase. And I anticipate that we're going to continue to see that steady increase, particularly coming out of certain sectors that might have high areas of capital expenditure. We think about the need for continued growth in power generation related to the increase in data centers. So that natural use case will continue to grow. Similarly, as you think about the regulatory framework that has been changing over the years for bank capital, both in Europe, in the US, in any of the major areas, Australia, Canada, the regulatory changes will require banks to understand how much capital that they need to have in reserve and what is the most efficient manner for them to raise that capital.
Right. So you said, is Europe far more active for this kind of instruments than the US?
I
And
would say
yeah,
the number of issues that have been issued in Europe
right,
is probably, it's in excess of the number of issues necessarily. But I think what we've seen is a consistent, steady growth globally
right,
for the demand for these securities and the
right,
demand for issuers to be able to utilize the benefits that they see
right,
by having a security that does, in many cases, give them a non-dilutive equity content
right.
within the capital structure that makes it a very efficient form of funding.
Has the monetary policy cycles affected the issuance of volumes or the attractiveness of this kind of financing? COVID, obviously, we started from zero interest rates, had a rather rapid tightening cycle. Now we had a brief easing cycle, and now we're sort of sitting here. Some countries are looking at hiking rates, others are looking at easing rates. So sort of an uneven policy outlook. But does the cycles of the monetary policy affect those markets at all, Dan?
Absolutely. And if you think about when we had basically zero interest rate
Right.
policy globally coming out of COVID, that dynamic afforded a much, much lower cost for many of these borrowers to be able to raise equity content securities.
Hmm.
If you think about just a simple capital structure, equity is going to be your most expensive cost of capital. So even if you just wanted simple growth capital, if you could do this in a more efficient, lower cost
Right.
manner, we're going to take advantage of that. And if you can do it in a non-dilutive factor, then it fits for all of your shareholders, both your fixed income investors as well as
Right.
your equity investors. So when we saw a lower interest rate environment, it was a catalyst that spurred the use of these securities because they became so economic, where many of the yields or spreads that these securities were being issued at were more similar to where unsecured financing would have cost them not too long ago. So when you had, coming out of COVID, you had a zero interest rate environment. We had long duration, high equity content securities that were being issued with 4% coupons, with 5% coupons, and a
Right.
handful that even had 3% coupons within the US, and even lower in other areas around the world. So that dynamic, when you think about what that cost of capital was for an issuer to either strengthen their balance sheet or utilize this for growth capital to meet those needs, it really did spur a decent amount of volume in 2021 as the markets really started to become more comfortable and less concerned coming out of the pandemic. And
Right.
when we saw that growth, the growth in these securities, it was offering a higher return for investors that were eager to grasp on what they felt like were excess returns. And this was a sector and a product that they could do that in.
Right. And in terms of investor types, has it also has the kind of investors who are coming into this product actually expanded as well over the years, you think?
It has, and this is, I think, another area that junior subordinated debt, particularly when the rating agency treatment allowed issuers to maintain a similar type
Right.
of content that they would receive in a preferred stock issue, that was something that isn't tax deductible.
Right.
As those components aligned, some of the features that are involved in a junior subordinated debt structure that are materially different than a preferred stock structure allowed a more diverse group of investors that, by investment standards, strategy, requirements, might not allow them to buy a perpetual security, may not allow them to buy a security that is deemed to be stock or equity within their fixed income portfolio.
Right.
Well, now all of a sudden you have these securities that are dated, that have the features that don't require a conversion to equity, but
Right.
still allow for the equity treatment from the agencies. So that pool of investors has continued to increase over recent years. And I would say that the change from where we were 20 or 30 years ago within these securities, when they were much more bespoke, much more highly structured, to a place that we sit today where the structures globally are very similar. There are some slight nuances, but what it has allowed those debt portfolios that might have been restricted from some of these other securities, it gives them a format that allows them to invest in them.
Right. And Dan, I wanted to talk a little bit about how these complicated instruments have performed over the years as well, right? Like we had one incident with the collapse of, Credit Suisse when everyone was talking about AT1s, right?
Yes.
And which is one of these types of instruments. What do you make of it? Like that was like a severe test of the structure.
Yeah, we've had a couple of them
Oh,
over the years. If you think about, you can go back to the financial crisis, in which there was clearly severe stress in the banking sector overall, and a number of banks had these securities within their capital structure. You highlight one of the more recent ones. Silicon Valley Bank had some debt outstanding as well. The dynamic of these securities, whether it's a loss-absorbing capital transaction that's meant to operate in a significant period of distress,
right.
you could argue that security operated exactly as it was set up to perform. I'm not going to argue the merits of whether the trigger event occurred or didn't occur, given the way that many could interpret it. But if you think about the dynamic and the way that the security is actually structured and what it's structured to do, in that case, it was meant to absorb that loss in a manner that an investor provided the investment structure. So again, I think we haven't had too many, especially very large examples of a triggering event take place. There have been only a few over recent decades of meaningful magnitude, but they are designed very specifically, particularly in loss absorbing capital trades, to sit in and operate in a distressed scenario. And you know, I think the argument of whether that was actually a distressed scenario and whether there was a sale and whether that should have been exercised, a very different argument, as opposed to how does the security operate. So we've seen a couple of examples in which case that mezzanine level, that place within recovery of an investor and how it's supposed to sit in what could be deemed a bankruptcy or some stress scenario, that's really where these securities are supposed to sit. That's the reason why they come with a premium versus an unsecured or even a secured or subordinated debt profile. And that's the way they're supposed to operate. Right.
And do you think did that hurt confidence while everyone is trying to figure out what's the test of these structures? How did it impact the market, and how has the market recovered or not?
Yeah, and I think there's been a couple examples. And again, if we go back to the financial crisis, you know, these securities are built with a final maturity, but they do have call features. And depending on the rating agency and the issue structure, the content of equity assigned to these securities will be diminished over time. And I think if you look at a number of scenarios we've seen going all the way back to the financial crisis and through today, the idea that an issuer, upon getting close to a period of time when that equity content will be reduced, they have the ability to replace these securities. They can call them and refinance them. So there's a couple different dynamics we've seen in which case some of these securities were in a position to be either called, refinance, potentially lose equity content, but it wasn't necessarily a financial incentive for an issuer to do so. Meaning leaving that security outstanding as opposed to calling it and refinancing was a more appropriate transaction from a capital markets perspective for that borrower. We did see a number of those scenarios, and that's a place where, as you highlight, some investors will start to get a little bit concerned as they feel like these securities are meant to sit in that capital structure, hopefully never to be tested. They know it's there. And if we get to an interest rate environment, and this is an overlay on macro, in which rates are significantly higher and that cost of refinancing would be in excess of what it would be to just retain the security, there might be a financial incentive for an issuer not to take out these securities.
Speaking of which, what you know, as this war broke out back early last month, what you know, we've had an ongoing debate trying to go back to the COVID era when, as interest rates were at zero, and we saw this supply chain disruption caused by the pandemic, and it was pretty obvious that it was going to be an inflationary create an inflationary wave around the world. And so corporations rushed in to, you know, lock in financing at cheap rates. What's your view on the potential supply chain disruptions, you know, from this war? And, you know, do you compare it at all to COVID? I mean, are issuers looking to, you know, is a guy coming to you saying, Dan, you know, I think oil's going to be at $150 and we're going to have real problems. I need to lock in now. Or is it the opposite view where, you know, things are going to pass over and this is going to be fairly short lived? What are you seeing out there? I mean, I could be convinced either way, to be perfectly honest. But
Yeah. Well, I think there's a couple dynamics, and if you look at issuance year to date, right? We're and again, this is a global dynamic. Doesn't matter which market you look. We're in excess of where we were last year, anywhere from 10 to nearly 25% in most markets that were up year over year. Similarly, if you went back last year, you saw again a staggering amount of volume that was being issued. So the demand from the buy side for investment grade fixed income product is there globally. That's not unique. I think specific to the question that you asked, are we seeing issuers look at what is going on geopolitically and taking a view in the way that they want to, if we think about their capital raising needs on the course of the year, does it feel like we've seen some issuers taking advantage of a strong tone earlier in this year that they could see more volatility built into the back end of the year? Absolutely. There's no doubt that we've seen financing brought forward. I would even argue we saw financing brought forward because the market was so strong last summer and last fall that was anticipated for 2026. So the dynamics that we've seen over the last month and a half since the events in the Middle East have taken place has spurred these conversations around what is strategic, the importance of maybe warehousing a little bit excess capital, the excess cost of carry to do that type of warehousing, and on the other side, do we think that these events could lead to potentially lower interest rates if we do see a more meaningful slowdown? I think that concept and what we saw around COVID was a meaningful warehousing of capital just with uncertainty. For the most part, when we do start to see a meaningful amount of uncertainty built into the credit markets in general, you will tend to see particularly the largest borrowers on the globe. And this goes from, if you think about the super sovereign agency market, the largest, most frequent borrowers, to the smallest market, you tend to see them look to be a little bit more aggressive, pre-financing, take some of the risk off the table earlier in the year. And that sense that if later on in the year, the markets do stabilize or we do see an event that might trigger a better funding opportunity, well, doesn't mean that you couldn't take advantage of it something later in the year, but I don't want to put all my eggs in that basket. I would rather understand the market we're in. I don't want my financing to be the tail wagging the dog on
reactive rather than proactive. Yeah. I mean, so you think that there was a sufficient sort of warehousing early January, February, that issuers are fairly sanguine about this point in time and just willing to see how it plays out?
Yeah, I think there's so many factors going into what their financing plans are going to look like and how they might have been impacted based on the way that interest rates have moved, based on input costs for whichever business they might be running, for everything from a financial institution to an industrial company, and the way that it all impacts their earnings and their returns. And look, we have seen this volatility that we've seen broadly speaking in the market, whether that's from what's going on in geopolitical realm to what's going on with technology and the impact of AI and the way that different businesses are operating. So some might be saying, here's an opportunity for us to warehouse capital. Others might say, based on what has gone on in the equity market, we feel like our equity is undervalued. We want to go repurchase some of those, and we feel like this is an opportune time. And by the way, the bond markets are fully functioning, and this gives us an opportunity to utilize the bond market as a source of capital to go finance our share repurchase, our debt repurchase, or our growth. Because as we look, and we've seen the one dynamic even over the last month or so, is that the fixed income markets, when we've had periods of relative calm, have been very efficient. And again, that's a global phenomenon, whether that's within the US, we've seen better days for financing, but we've seen large amounts of financing going through this market in all areas of capital raises, from senior unsecured to junior subordinated debt, to preferred stock over the last month in very efficient manner.
So you see, like, just bringing it back to hybrid a little bit, I'm sorry, is that, so when there is a warehousing of capital, so you're saying that there will be a lot more issuance of hybrid, because they build this regulatory capital, it's like a buffer against extreme circumstances as well, right? Like, do you see a lot of that issuance coming in?
I think it's a little bit more strategic than that.
Okay.
And what I mean by that is when we had the volatility built in with the pandemic, what that drove was a zero interest rate environment. It made the cost of raising capital in junior subordinated hybrid preferred form at historically low levels, even though they were at meaningfully high spreads, right? When you have zero interest rates and you issue at 4.5%, 450 basis points over the risk-free rate is a lot of excess spread relative to a historic level. As we've had a higher interest rate environment today, but people could offer a more normalized yield curve, this becomes a little bit more strategic. And my point around this volatility and warehousing isn't that they're necessarily warehousing in junior subordinated or hybrid securities, but the market, as we see stability, and given that this form of capital, depending on what they're using it for, is and has been able to be raised in a, I will say, a relatively cost-effective manner, it's going to give an issuer the confidence to go do that. So the majority of that warehousing, I would suggest, is in straight unsecured financing. But the elements, I think, of why an issuer is looking at this, and as we get into one very, very unique feature of some of these securities, a reset of the coupon that will take place after a call period. And if you go back and you think about the issuance that we saw coming out of COVID in 2021 and early part of 22, when interest rates were so low, many of those securities had 5-year resets or 7-year resets built into them, which led to 25 and 26 being a period of time that we would see just naturally, even if we didn't have any growth, a need for an issuer to make a decision whether they were going to call that security that was outstanding that they issued 5 years ago, because the all-in cost of refinancing was more efficient than just letting the coupon reset or the dividend rate reset, depending on the structure.
And talking about, like, this particular product helps in reducing leverage, or not hurt your ratings. Do you think AI hyperscalers, who are like all over the place, trying to borrow money from everywhere, do you think they will start adopting this? And if they do, then the volumes will be massive in these markets, right?
Well, again, you have to understand the use case. They're not going to just issue a high equity content security because they can. The one thing in particular about hyperscalers, for the most part, these are some of the most highly rated borrowers on the planet. So that need for equity content built into a security might not be quite as necessary, depending on the hyperscaler specifically. However, if you think about the related ecosystem and you think about the growth in capex just coming from the utility space, if you look, you have a capex budget out of the utility space in the United States that has gone from that has gone up year over year by nearly 75%. Well, if you think about how utilities have heavily regulated industry, how they have to maintain a certain amount of leverage, if you have growth and you need growth capital, here's a place naturally that would fit to utilize junior subordinated debt to see an increase in volume. Is that specifically related to the hyperscalers? Well, no, because it's not their credit that is being financed, but it's a need for capital expenditure based on the relationships and the developments they have with those hyperscalers. And that's just one, I would say it's the largest subset, but it's one subset that is directly related to the impact on the growth in the hyperscaler.
Right. And the other main topic nowadays is about this whole cracks in private credit. Or we had a guest last week and from Fitch Ratings, who's an expert on private credit, and she looks through a lot of these ratings and companies. And she said, we don't see a financial contagion risk. Do you agree with that? Like, do you think that's a worry? People were like overinflating, maybe?
I never get concerned when people are worried about credit. That's what fixed income is all about. We like to be able to go sleep at night because we understand the risks that we've hopefully been able to price appropriately. But the rhetoric, I think, and the information that's out there is really the hardest part about this. It's called private credit for a reason, and being able to peel back the layers and the disclosure. If you think about the non-bank lenders versus bank lenders, and you have a regulated group of issuers
Right.
versus a non-regulated group of issuers, the flow of information is just more transparent on one side than the other. The concept and the fear, and you think about the strength of the balance sheet of many of those issuers, particularly the BDC space, many of them have been upgraded in the last 18 months. So the rating agencies clearly have a pretty strong view on this. Not every one of those borrowers, no different than any other sector in the markets, are created equal. Some of them take more risk, some of them are more heavily concentrated in certain sectors. So the dynamic, and I think this is a place where even the unsecured issuance coming out of the BDC space, similar to what I would equate in something like the hybrid space, this is the highest beta part of the investment grade fixed income market. So when you do start to see volatility creep into this market, you're going to see those areas hit the hardest. And that type of volatility is represented in spreads widening out, markets from traders widening out, liquidity becoming tighter, and liquidity really easiest for the largest, most trusted kind of borrowers in that space until more stability comes back into place. So I think the markets were reacting appropriately for concern. If you ask, do I think the concern is warranted? You know, that's what makes markets, and that's where a credit decision comes into play.
Hey, Dan, do you, we have the major central banks sort of have very divergent policy paths at this point. The sort of the single mandate central banks are looking at this war in Iran as an inflationary driver that's going to have to be met with higher interest rates, whereas say a dual mandate central bank like the Fed has to look at the potential impact on slowdown in the employment market. So its interest rate trajectory is notably lower than in the Europe and the UK. Does that create issues or opportunities for your market, or how are people looking at that?
Yeah, absolutely. I think the dynamic around interest rates, particularly when you think about the largest borrowers in the markets, and that again, it doesn't matter whether you're a large borrower coming out of Europe, I'll say coming out of Canada, coming out of the United States, coming out of Australia, as I think about where our major markets are, we as an underwriter have insight and flexibility to be agnostic as to markets. Our goal is to advise our issuers on what the most efficient market for them to raise capital in. And if I think about the hybrid market in general, this is a place where many times, and we've seen this, I think, meaningfully illustrated in the last couple of years, that the capital and those issuers are going to flow like water to the most efficient place to go find it. So as you've described, as interest rate policy has impacted yields in these various markets, we've seen borrowers that might be US domestic borrower going into sterling or euro markets. We've seen Canadian borrowers coming into the US market. We've seen European issuers coming into the US market or other markets to raise capital. So as we see a lower interest rate environment, lower yield environment, that has led to different types of supply in various markets. I think it's a very important concept, and it's something that we look at on a daily basis. Where's the most efficient market to fund in? What is the lowest cost market for that borrower? Which market would accept a structure that fits with their capital raising, whether that's, again, regulatory or balance sheet need. But cost is always at the front and center. And given that we've seen lower yields in some of these other markets, it has absolutely led many issuers to go find the appropriate market, regardless of which major currency they might need to actually have that capital raised in, and regardless of where they're domiciled.
But does that change if like UK and Europe raise rates, but the US holds or cuts?
Absolutely. Absolutely. And we have witnessed it. I think probably the best example over the recent number of years has been in the telecom space, the global telecom space. And I will say the US utility space or utility space in general is coming on strong here. But here's a case where many of the large Canadian telecoms have issued in US dollars because you had a more efficient market. You've had US telecoms issuing in non-dollar markets, whether that's sterling or euro. You've had European utilities issuing in US dollars. So all of this really comes down to what's the most efficient cost, what's a diversification play from an investor perspective, and that's another dynamic. We haven't even gotten into some of these structures that we utilize, and because right now we have at RBC one of the larger wealth managers in the United States, that we actually structure securities that are specifically targeted towards retail investors as well, given that there's strong demand from retail, just like there is from an institutional market. So an investor diversification for many of these large borrowers is also vitally important because it helps them to mitigate some cost over time.
So getting retail involved, you think retail understand the nuances well, you think, or this particular asset class has been there for decades, so people...
Yeah, that's where I would liken it to. This particular asset class, particularly when it in regards to the distribution between institutional and retail investors, has been around for multiple decades. This is not, in that sense, a new product, and it's one that the retail and the high net worth, in particular, wealth management organizations are always keenly eager to participate in. And again, similarly to the reasons that an issuer might look at it, there might be tax advantage reasons for an investor to look at these securities. So in many cases, those investors are looking at those structures as well, even on the retail side.
So Dan, I wanted to ask you about like private credit. In the last few days in the bond markets, at least, we are seeing a number of BDCs come to the market. They're getting massive books. So has the tide changed? Like now people are less worried. The credit markets are actually showing more support to the sector.
There's no doubt in the last couple of weeks, we've seen broader stability built into that part of the market. The volatility has probably been, as we talked about, this is one of the higher beta sectors. So you've seen spreads kind of whipsawed within a 25 to 50 basis point range, depending on what the issuer looks like. But as we've seen I will say, broad stability of the fixed income market, and you had a credit index that hit historic multi-decade tights at the beginning part of this year, widened out about 10, 12 basis points, and has since kind of come back, not quite at the historic tights that we were, but towards them. That type of stability has given a little bit more comfort. We've had more information. We've had an earnings cycle, which I think is very important as more information comes out around where and how these issuers are performing. It's created an opportunity for them to return to the market because investors, I would argue many of them didn't necessarily go anywhere, but they were waiting to see what information was going to be put forth that they could continue to make an educated decision to participate or not participate. And I think what we've seen the last couple of weeks is that stability and that information flow has led to opportunities for both issuers to come back into the market. And as you said, we've seen some very strong responses. We had one earlier this week. And I anticipate that we continue to see that coming out of earnings over the next few weeks.
Yeah, I mean, I know a lot of these BDCs have a significant portfolio in software companies, and had a nice little rally in the sector in the last few weeks.
Right.
SAP was out overnight with some decent numbers, and you know, again, it looks like the sort of the panic has passed, certainly in that sector.
I also think it's important, and this goes, I'm going to bring it back to kind of our topic of conversation. This goes to why issuers utilize certain markets,
Right.
why they set up their capital structure in a certain manner. Having liquidity for the proverbial rainy day is very important for many borrowers, and understanding the different areas that you can obtain liquidity if one market isn't efficient, that
Right.
you have a safety net, an insurance policy built in, whether that's credit facilities, whether it's some other form of area for capital raise. At some point, again, when you think about the spectrum of equity to straight senior unsecured, there's a myriad of different areas and different investor sectors that we can go raise capital in. If the public market for senior unsecured funding isn't efficient, we're going to lean into a different market for these issuers. And that's really what we saw take place when you see bouts of volatility. Not unique to the BDC space. It's just, I think, the most recent one that is a good example. The dynamic that we've seen, even with this volatility, really hasn't created a liquidity crisis, which is, I think, the most important concern that we have within fixed income. When you have liquidity issues, that's where you start to see distress scenarios.
Right. Right.
And do you see private credit using hybrids? Are they talking about it at least, or asking you questions on it?
So, again, it depends on how you define private credit in this case. If you think of the
Right.
large asset managers that own a number of the BDCs at the top of the house, yes, many of them, if not all of them, have used some form of hybrid capital.
Okay.
Again, are they doing that because of the growth in private capital, or are they doing that because it's the most efficient way to fund their balance sheet and growth? So the short answer is yes, but I don't think that's really who you're asking about. Do I see the need for a BDC specifically to raise this type of capital? I would say it really, really depends. And that's, I know a little bit of a tepid response to that question. That being said, you have to understand again, the catalyst for that need. If they wanted to go, if they see a great opportunity for continued growth because they see great opportunities, well, absolutely, it's going to be a more efficient means for them to raise non-dilutive equity if it fits within that capital structure. If this is meant to just protect their balance sheet and to fend off a weakening credit metrics, they have flexibility. These issuers, these entities have, if you think about what their assets on their balance sheet are for the most part, are usually very short loans. Well, to me, that becomes a time dynamic. If you can extend past this and you do have performing loans, the need for this type of security might not fit.
So Dan, I wanted to ask you, because you have had a wide experience. You've covered so many different things. You've done so many different, worked in so many different places. How have the markets changed according to you? And I always ask this question to credit people, like very senior credit people, is will we see another Verizon trade, right? Like, is the market grown in capacity over these years to a level where if there is a lot of dollar issuance away from higher interest environments, do you think the market has capacity to double the size it already is, which is massive?
Yeah, the dynamic in the number of years, if I just think about the trillions of dollars that have been raised recently, that magnitude is, as I think about when I started in the mid 90s, it's staggering, the volumes that we talk about today. I think the major changes that you think about are the efficiency and the manner in which we can raise capital today. This is an absolute story in where technology has fundamentally changed the way that we raise capital, the efficiency, the speed that we can do it in. And if you think about some of these very large transactions that we've had, either they were M&A related or a large capex need coming out of some of the technology borrowers that we've seen this year, the efficiency to be able to raise 10, 20, $30 billion in multiple markets in the course of 24 or 48 hours.
Wow.
That would have taken weeks, or months even, many, many years ago. As we've kind of grown into a market that has, I think, embraced the use of a more efficient means of financing, both investing as well as issuing, it's created an opportunity for speed to become really a primary characteristic of our markets.
Right.
And I think that that's something that the efficiency of how the functioning market in one region compares to another is also being able to be done much more quickly. So I do think the markets in that respect have benefited massively from the changes we've seen, number one. And then number two, the education of buy-side investors, as well as the education of issuers, as we've talked about securities like hybrid securities, and we think about the nuance of some of the structural differences between the region and the market, between banking regulatory framework, the need for a better understanding on how these structures are meant and intended to work, has become more clear. That information flow is more dynamic, and it's brought in more investors into these products.
So I think that, Dan, what, like me covering these markets for so many years, I think people don't appreciate how much syndicate desks actually do, because I covered it during the COVID crisis when there were record levels of issuance, and there was social distancing, which is like no one talks about that word anymore, or that two words anymore, but it was amazing. What was your experience during that time? Like, how did the market manage to do volumes when no one in the office? Coordination was an issue. Everyone is away at home. Everyone is scared at that point, right? Like, how do you get on to work and achieve that level of efficiency?
Well, I think two things are very important. You hit the nail on the head. Communication was paramount, right? You needed to be able to communicate not only with your team that was spread out, not only with issuers, but investors. And at the end of the day, this is still a relationship business as much as anything else. And this is a place, if I look back, that's a place where trust and communication that had been built up over years and decades really was paramount in being able to execute, particularly in the early days, before there was a sensible cadence built in to everybody's work from home scenario. And I think that is, again, one of the things that we've taken away from that period of time, and it's continued to grow into this market, that communication and efficiency are there. But ultimately, the relationship, when you've known somebody on the other side of the phone for 5, 10, 15, 20, 25 years, there's a level of trust built in that if you say you think you can do something and get it done, they're going to give you that opportunity because they need the help. And that's where I think, particularly some of the syndicate traders that might have a little bit more gray hair could benefit in a period of time like that.
You have lovely hair. So I also wanted to say, what advice? So if, there are so many young bankers who you have, mentored and they've grown through the ranks over the years. What is your advice to upcoming bankers, like people who are graduates, and how do they get into this career path? What will help them get into this career path, and what are they supposed to learn?
I think it's really important. I mean, you hit the nail on the head, learning. What do we expect from the junior bankers is that there's a willingness and an openness to be voracious readers, to be aware of the various markets, to be willing to become uncomfortable and extend into areas that they might not have an expertise or familiarity, that's going to lead to a much better basis that you can look at different opportunities and make stronger recommendations. So to me, being able to watch not only what's going on in your local market, but what's going on a global basis. What are unique characteristics that are driving the increase in volume in euros versus something in the sterling market? Why are we seeing European banks looking at opportunities in the Canadian market? What efficiency has driven some of the SSA borrowers to look at the Aussie market as a foothold into Asian market distribution? Being able to look across sectors, across markets at a junior level is really, really important. And understanding, and what's very important too, is to bring something to the table, bring new perspective, bring new ideas. People are looking for alternatives and new ideas, and we want those that can analyze what they're seeing, but also be able to be thought leaders as well. And given the amount of information that is at everybody's fingertips today, being able to synthesize that and be a contributing member of the team is vitally important.
Even in our business, Dan, I mean, I was on the other side of this and a customer of our business for several decades. And it's one of those things where information is commoditized and there are a million people running around with opinions, but tell me something I don't know. We're all sitting in front of screens. We all see the same information, right? Tell me something I don't know. And it sounds like that's what you're encouraging your young bankers to do, is to, differentiate yourself in some way.
My phrase is, I don't need a weather report.
There you go.
There's an app for that.
There you go. Yep.
I can look out the window too.
Right.
And with that dynamic, it's not that everything that anybody that you're going to say has to be the most provocative thing we've ever heard, but I want to understand that we're creating thought leaders. We don't need processors in this market. We need thought leaders, and that's something that I think having the right mentor, having the right team, and understanding, how you can participate in that is the thing that really differentiates a lot of the junior talent from the rest.
Gotcha.
So do you think AI efficiency, will that change this?
Absolutely. It already has, right?
Oh,
and, in many ways, when we think about the impact of technology, as kind of I stated, just thinking about where we were in the mid-90s to where we are today, in the most basic form of when I started, we had a Unix system, I had a Monroe calculator, the Pentium 286 in my computer. The power that we have today that probably sits in our phone is stronger than when we were sitting on trading desks, back in the 90s. But the dynamic and what is going to be available with AI, not only from repetitive tasks that have been part of either debt capital markets or investment banking or sales and trading for many, many years, clearly being built in more efficient models, allowing for the value that we're talking about of decision making and coming up with creative views becoming much more important. So I definitely feel like the continued development that we're going to see, the use cases for AI right now, everybody is in a similar manner trying to figure out how best we can utilize what we have and in what manner we might be able to use it going forward. So I think I don't know if we're in the first inning still, but we're definitely in probably the first third of the game at this point for where we're sitting on the use case and how that's going to continue to develop. And I think it's going to continue to be very rapid growth over the very near term here.
Thank you for all that, Dan. It was one of the most fascinating conversation for me, and I think because we talked about complicated subjects and we talked about life. And thank you all for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts. And tune in next week as well, where we again bring a brilliant guest to talk about some other credit trends. If you want to receive real-time reports, market data, you can request a free trial of IGM services. Please do. And the link is in the show notes. Thank you again, Dan. This is such a pleasure.
No, thank you both for having me.
Thanks, Dan. Appreciate it.
Thank you very much. And have a nice weekend all. Thank you.